Welcome to Financial Perspectives, the podcast, where we cover timely topics related to the current economic environment and keep you up to date on investment news. We also provide insights on how investors can maintain a long-term perspective. Please stick around at the end for important disclosure information. More information about Foster Group can be found in our ADV brochure at fostergrp.com.
So what's the most surprising thing that's ever happened in your lifetime? I expect for many of us who lived through the COVID-19 pandemic, it may have been seeing the world basically shut down for what amounted to months. People were confined to their homes, businesses were forced to shut down entirely, meetings were moved swiftly from in-person boardrooms to Zoom screens, showing us all working at home, or at least trying to work from home. Before COVID, the biggest surprises might have included the great financial crisis and the mortgage meltdown, or how about 9/11 and planes being flown into the World Trade Center? Those are three very big surprises in the last quarter century that were largely unpredicted before they happened. Now, not all surprises are negative, right? How about the quick recovery of the stock market in 2020 and 2021? The rapid development of a vaccine for COVID-19? The boom in artificial intelligence that has produced unexpected productivity gains? For Iowans, did you see the coming of Caitlin Clark making three-point shots from logos on basketball courts all over the country and in front of sellout crowds? Those things were just unheard of and extreme rarity in women's college basketball until recently. The world is and has been a surprising and uncertain place. As Nobel laureate and everyone's favorite behavioral economist and psychologist Daniel Kahneman says, the thing to learn from surprises is that the world is a surprising place. Last month, we talked about the first of Foster Group's 5 foundational principles, that was constructing plan-driven portfolios. We'll include a link to this episode, which also included a few words about Bitcoin back then. But this week, we're going to look at principle number 2, which says simply, embrace uncertainty. I'm going to quickly give you 4 positive reasons to embrace uncertainty and 2 big dangers of not embracing uncertainty. First, the positives. Embracing uncertainty helps us manage expectations. It's going to encourage diversification. It's actually a source of higher expected returns, and it motivates preparedness. So how does embracing uncertainty help us to have realistic expectations? Well, Charlie Munger said the first rule of a happy life is low expectations. If you have unrealistic expectations, he said, you're going to be miserable your whole life. You want to have reasonable expectations and take life's results, good and bad, as they happen, with a certain degree of stoicism. That's what he said. Now, if we expect the world, especially financial markets, to be predictable with no stressful volatility, to only go up and never expecting them to fall and perhaps fall a lot, well, we're going to be unhappy, miserable, as Munger notes. History is a good teacher here. The world is constantly experiencing surprises, unpredictable events, and uncertain outcomes. If our expectations are otherwise, we will be miserable. I often say we don't know what our expectations are until they haven't been met. If we expect certainty, we'll be disappointed with reality. If we embrace uncertainty as part of the nature of the world we live in, we at least have a chance at happiness and contentment, at least more often. Embracing uncertainty also encourages diversification. Joe Wiggins wrote that diversification is an acceptance that the future is inherently unknowable and can take many different directions. He also says diversification, if done well, provides protection against both uncertainty and hubris. Now, diversification is the investment concept for don't put all your eggs in one basket, or don't pin all your hopes on one thing. It's a common sense idea of risk management backed up by all kinds of academic research. And when we embrace uncertainty, we acknowledge that the future will be different from the past, and even that things could have been different in the past. If we agree with that common sense observation, then we acknowledge that any asset or investment may experience an unexpected catastrophe, no matter how remote the potential may seem at the moment. Morgan Housel notes that on September 10th of 2008, Lehman Brothers went from a Tier 1 capital rating, at that time that was higher than both Goldman Sachs and Bank of America, and they went to bankruptcy in 72 hours from that Tier 1 capital ranking. So embracing uncertainty may also actually be a source of higher expected returns in our portfolio. Let me ask you this question, agree or disagree? Not all stocks have the same expected returns. So what does it mean if we agree that not all stocks are created equal? Well, one, it should mean that the current price of a stock reflects the market's expectation of future return, as well as the likelihood of getting that return. That means the more uncertain the future stock price, the lower the price investors are willing to pay for it today. The lower today's stock price relative to a future expected value, the higher the discount rate or the expected rate of return. Think about that for a minute. If a stock that is expected to go to 100 is selling at 90, that's a 10% expected return that people are paying for when they buy it at 90. If a different stock is also expected or hoped to go to 100, but it's selling for 50, well, the expected return on that stock is now 100%. The stock price needs to double. What people are saying is, hey, it's less likely that stock B is going to get all the way to 100 as opposed to stock A. That discount rate or expected rate of return is what an investor demands in return for bearing risk, for bearing the uncertainty of the stock price going up enough. No one buys the stock unless the reward for bearing the risk is potentially high enough. So expected returns are generally higher as uncertainty increases. And this is reflected in lower relative prices. Sometimes investors get more than the discount rate, sometimes less. Sometimes in high-risk situations, they might get nothing. When we embrace uncertainty, we realize that relying on predictions to prepare us for a surprising world is not a high probability way of succeeding consistently. There are things that can go wrong that we can imagine, and more worrisome, there are things that can go wrong that are currently beyond our imagination. Again, as Morgan Housel writes, risk is dangerous when you think it requires a specific forecast before you start preparing for it. With this thought in mind, Nassim Taleb, author of Fooled by Randomness and the Black Swan, encourages people to, quote, invest in preparedness, not prediction. For investors embracing uncertainty, this likely means holding some assets that are as disaster-proof as possible, like treasury bills and money markets. In day-to-day living, it may mean having an emergency kit in the house or car with things like water, fresh batteries, some non-perishable food, maybe some cash. You're preparing in general for an event that you are not able yet to specifically predict. In California, buildings are constructed to survive possible but uncertain earthquakes. In Florida, it's not earthquake preparedness, but hurricane preparedness. On the other side of the coin, it's possible to be prepared for good things. The stock market, for instance, generally rises, though not always. In preparation for future positive returns, an investor needs to have a plan to stay invested. Since you must be present to win in stock market investing, if you embrace uncertainty, you'll be more likely to stay invested. So what happens if we don't embrace uncertainty? Well, a couple negatives are, I think, one, we risk becoming fragile. The second is, I think we risk becoming vulnerable to short-termism, or something I'm going to call false promises. The first one, this idea of risking becoming fragile, is really the flip side of preparedness. Carl Richards, a financial writer and artist, he states that risk is what is left over after you've thought of everything. That's kind of a good one. I like that. It's another way of saying that comes from Professor Elroy Dimpson. He said risk means more can happen than will happen. If we embrace uncertainty, we give ourselves the opportunity to be prepared for a wide range of surprising outcomes, both good and bad. If we don't embrace uncertainty and then risk all or the majority of our assets on a narrow prediction, it follows that we are relatively more fragile if unexpected outcomes occur. In the late 1990s, stocks associated with the dot-com bubble were going up like rockets. Then in 2001, the air came out of that balloon and the dot-com heavy NASDAQ fell by over 50% of its value in a year. Now, I'm not predicting that this will happen. It is possible, for example, that the AI wave that is driving artificial intelligence associated stocks higher, well, that wave may at some point break and result in significant losses for those who have made big bets on only those stocks. The same could be said for Bitcoin. The second idea here is if we don't embrace uncertainty, we risk vulnerability to unrealistic and dishonest investment pitches. Thinking that uncertainty can be eliminated, we will keep looking for someone who promises certainty because as human beings, we would prefer certainty over uncertainty. But from Bernie Madoff and other Ponzi schemers to simple overpromising things which they cannot deliver or guarantee, sadly, the history of investment fraud just abounds. How does this work? Well, if something goes wrong with our current portfolio or plans, we'll be tempted to abandon it, not because it wasn't necessarily a good plan, but possibly because we just got impatient or unlucky. Nothing can be more detrimental to long-term investment success than a short-term mindset and a limited understanding of probability. If we don't embrace uncertainty when a result disappoints us, we'll start looking for someone or something that guarantees, however falsely, a better outcome. Historically, the U.S. stock market has experienced a negative calendar year return in about 1 of every 4 years. Since 1979, there have been 9 out of 45, or 1 in 5 years, where the stock market was down 20% or more during a specific calendar year, though it closed that calendar year down over 20% only 3 times. This is like saying that based on historical data, there's an 80% chance of not having a bear market this year. Well, that's the good news. But that's the same thing as saying there's a 20% chance of having one. That doesn't sound quite as good. Embracing uncertainty means that we expect bear markets as a regular cost of achieving long-term, better stock market returns, though we don't exactly know when they're going to occur or how long they'll last. Understanding risk and probability, well, that's critical to, as Munger said, takes life's results, good and bad, as they happen with a certain degree of stoicism. With this kind of outlook and understanding of history, we're less likely to fall for those folks who are promising the impossible, a risk-free, predictable, and certain future. So to recap, 4 very good reasons to embrace uncertainty as a part of our investment strategy include: 1, it helps us to manage expectations; 2, it encourages diversification; 3, it's a source of higher expected returns; and 4, it motivates preparedness. And if we don't embrace uncertainty, well, 2 big potential consequences are we risk becoming fragile. We also put ourselves or make ourselves vulnerable to false promises and short-termism. Educated optimism is an antidote for anxious uncertainty, and it can be of great help enabling investors to embrace the uncertainty that's with us all the time. We hope these presentations contribute to you becoming educated and prepared optimists. If there are topics or questions you'd like us to address, please let us know at our website, www.fostergrp.com, and click on the words Financial Perspectives. And if you're listening to this as a podcast, you can help us spread the message of educated optimism by liking us on your podcast app. As always, thanks for investing some of your time and attention with us today.
The previous presentation by Foster Group was intended for general information purposes only. No portion of the presentation serves as the receipt of, or as a substitute for, personalized investment advice from Foster Group or any other investment professional of your choosing. Different types of investments involve varying degrees of risk, and it should not be assumed that future performance of any specific investment or investment strategy, or any non-investment related or planning services, discussion, or content, will be profitable, be suitable for your portfolio or individual situation, or prove successful. Foster Group is neither a law firm nor accounting firm, and no portion of its services should be construed as legal or accounting advice. No portion of the content should be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Foster Group is engaged, or continues to be engaged, to provide investment advisory services. A copy of Foster Group's current written disclosure brochure discussing our advisory services and fees is available upon request or at www.fostergrp.com/disclosures.